If, just 2 months ago, anyone at an investor lunch in Midtown Manhattan had dared to suggest that Google is a more certain AI bet than Nvidia, they would have likely been laughed out of the room. At the time, Google was written off as a sluggish straggler playing catch-up. Yet, precisely when market sentiment was at its most pessimistic, when the mockery was loudest, a very familiar figure quietly made his move. Warren Buffett. With his characteristic silence and decisiveness, the CEO of Berkshire Hathaway loaded up on 17 million shares of Google, a stake worth a staggering $4.3 billion. Is this merely a coincidence? For anyone familiar with Buffett's philosophy of value investing, the answer is a resounding no. Buffett doesn't pay for hype. He pays for a certain future. With the recent earth-shaking release of Gemini 3, Wall Street and Silicon Valley have finally had their epiphany. The market previously made a massive cognitive error. We assumed Google was breathlessly trying to keep pace with OpenAI. The reality, however, is that Google wasn't just running the race. It was redefining the track. Google has executed a textbook full-stack vertical integration, creating an insurmountable competitive barrier around the entire AI value chain. Yes, Gemini 3's benchmark score of 1,501 is impressive, but that is just the surface. The real inside story and the trigger for Buffett's investment is that Google has unlocked the most formidable business model in the industry, a natural monopoly approaching zero marginal cost. In this video, we will skip the dense technical jargon. Instead, we will dissect this through 3 core financial and strategic lenses to explain why Gemini 3 isn't just a large language model, but what Buffett sees as the ultimate free cash flow machine for the next decade. First, the reconstruction of financial logic, ultimate pricing, power, and profit moats. As a rational investor, you need to look past the headlines. While tech media obsess over Gemini 3 having 10% better reasoning than GPT-5.1, capital cares about the strategic metrics, specifically pricing power. The data shows that while the input price for Gemini 3's enterprise API hiked by 60%, corporate clients are still queuing up. Demand hasn't flinched. Does this defy basic supply and demand? No. It happens because Google possesses a unique full-stack advantage. Imagine this. Google is the only company on Earth that simultaneously controls the proprietary chips, the cloud infrastructure, Google Cloud, the core model, Gemini, and the distribution entry points for billions of users via Android, search, and YouTube. What does this mean? In a gold rush, every time a competitor digs, they pay a fortune to the shovel seller. Every time OpenAI generates a token, it effectively pays a toll to Nvidia, squeezing its profit margins tight due to hardware costs. Google, conversely, has internalized its compute costs through its mature, self-developed TPU clusters. This is the fundamental reason why Google Cloud's operating margins have surged to 24%. The launch of Gemini 3 marks a pivot point. Google has officially moved from the capital expenditure burn phase, spending heavily on infrastructure, to the profit harvest phase. This high-margin structure, built on a low-cost base, is exactly the kind of economic moat Buffett loves. Second, the evolution of the business model from search to intelligent agents. Gemini 3 has effectively ended the nightmare that haunted Wall Street for 2 years, the narrative that search is dead. Loop Capital, in a recent report, stated bluntly that fears regarding the disruption of Google search have completely evaporated. Why the rapid sentiment reversal? Because Gemini 3 isn't just a chatbot. Through the newly released anti-gravity platform, it has evolved into an executable agent. Recall that industry-shaking demo. With a single command, Gemini 3 didn't just answer a question. In under a minute, it wrote perfect code and deployed an interactive 3D physics simulation. Note the difference here. This is no longer searching for information. This is generating a service. Previously, Google offered 10 blue links to earn pennies in ad revenue. Now, by embedding this agent capability directly into a search box used by 2 billion monthly active users, a simple query transforms into a complex task execution. Google is upgrading a low-value search interaction into a high-value service delivery worth dollars. This hasn't caused traffic to flee, rather it has triggered an exponential jump in the value of that traffic. This is the second layer of logic Buffett sees, a reconstruction of user stickiness and an explosion in ARPU, average revenue per user. Third, the reshaping of valuation, finding certainty in a bubble. Finally, let's return to the core question for every investor: valuation. Before Gemini 3, the market priced Google harshly, treating it like a declining legacy advertising agency. Its PE ratio was at times lower than some boring consumer staples companies. But now, every valuation model needs to be recalculated. If the scaling laws hold true, if TPU clusters continue to drive down unit costs, and if agents successfully reshape the search experience, then Google isn't a relic of the old internet. It is the AI era's only true all-rounder. In a market environment filled with high valuations and froth, Buffett's $4.3 billion bet teaches us a truth: finding certainty is king. Google didn't just win on technical specs. More importantly, it won on closing the business loop. While competitors worry about hardware costs and monetization paths, Google owns the entire value chain from chip to user. The AI war may not be over, but for the capital markets, the chip with the best risk-reward ratio is already on the table.